Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And with me are two of our co-hosts, Mark Fitzgerald, Ramsey Smith. Welcome, both of you.
Hey, Paul.
Okay, we know we have arrived. Okay, when we have the guest, Ramsey, you recruited our show. Do you want to do the intro?
Absolutely. So Sheryl Moore is very well known in the annuity space. She's often called the annuity rock star. And we're delighted to have her here today to talk about really where we are in the market. So there's lots going on in the last 6 to 12 months. We had COVID, we had the Secure Act, we've had lots of different trends, and Sheryl Moore is always at the pulse of all these trends, and we think that this kind of color is going to be very valuable to our audience. So Sheryl, thank you very much for joining us today. And I'll ask you first to talk a little bit about what your mission is. You personally and specifically the company you run, and then we can just get right into what the environment looks like, both in terms of products and in terms of overall trends.
Thanks very much, Ramsey. I appreciate you inviting me to tune in today. I'm glad to be a guest, and I just appreciate any opportunity to educate people on annuities, as you know. So a little bit about who I am and what I do. I am basically the lady who is involved in almost everything that has to do with life insurance and annuities, whether it's developing products, tracking sales, correcting inaccurate media on these products, working with regulators. If you can think of it, I probably have my hands in it. So the reason why I do what I do is because I had a personal experience with annuities more than 20 years ago. And life insurance has been a part of my experience as well. And I'm very passionate about those products and just want to make sure that more consumers know what they are and how they work so they can make an informed decision on whether or not they'll be right for them. And I found out that my mission of educating people didn't pay really well. So I decided to start a market research firm, and I initiated Wink Inc. about 16 years ago. And really what we do is track every annuity and life insurance product that's available in the retail market and break down all the policy provisions, what the features are on those products. We track all the credited rates and caps and such, and then what are the sales like for those individual products. And all of that helps subsidize the work that I do in educating insurance stakeholders and insurance purchasers on annuities and life insurance.
So who are your principal clients? So that's fantastic data. Who typically is a Wink client? Is it insurance companies? Is it IMOs, agencies?
Well, it's just about everybody but insurance purchasers. I would say first we focus on like investment banks and actuarial firms, insurance companies, insurance distributors, and a little bit of insurance salespeople. But the only people we don't work directly with is consumers, but we do get a lot of consumers contacting us because I don't endorse any company or product, and they feel like I'm a safe person to ask their questions to. I am a licensed insurance agent though, even though I've never sold a case, I've never contracted with anyone. So I'm very careful in what I say to consumers. And, I will answer some basic questions for them and lead them to resources that would be helpful for them. But I'm very careful in what I say when I speak with them because I don't want them to misinterpret anything I say as advice.
Yeah, that's great. And I think it's kind of testament to what you've built over the years. I think, Mark, it's hard to go into any, business review, product review session without your numbers being pulled in and used in reference. So, I mean, it's pretty incredible, Sheryl, what you've built in terms of an authoritative voice here. So Okay, I've got to ask the question. Oh my God, is the sky falling today on the annuity business? Help me understand and
Yeah,
make sense of this.
I think sometimes I feel like I lack credibility when I speak about this because I haven't sold annuities and life insurance. And, one of the primary groups that I'm trying to help is insurance salespeople to help give perspective on this business, the products, and their own business. And so when I say, yeah, things are challenging, but the sky is not falling, I'm hoping that people aren't rolling their eyes because I'm not fighting to put food on the table the same way those folks are, Paul. But I am putting together our second quarter sales data now for Wink. And I will tell you that it is across the board not looking so positive. We are hoping to release final numbers probably the second week of August, maybe third week, depending on earnings calls from participants. But yeah, things are going to be down, and I'm anticipating sales of annuities will be down double digits. There will be some shiny bright spots for some certain product lines. I am expecting especially structured annuities to do well. And that's kind of a middle ground between a variable annuity and an indexed annuity. But yeah, it's been challenging, but I'm seeing a lot of silver linings in what's going on since COVID struck. And I think it's really important for people in this business to focus on those things because it is a challenge right now. But if there's one thing I can say about the 21 years I've been doing this is a very resilient industry. And we have dealt with so many challenges, whether it be industry, market trends, regulation, administration. We've had our business threatened a lot over that period, Paul, and we tough it out. We may struggle, but ultimately we always make it through. And I do have a complete confidence that once we pull out of this COVID mess and the 10-year treasury gets back to a reasonable level, that we are going to experience record sales.
So, I mean, a couple of very interesting things in all that. One is the resilience, and I agree with you there. I mean, one of the things I wonder about is, how much of the downturn is really an issue with just people having to change the way they sell. The need hasn't changed. Arguably, it's greater now than it was before. So, I'm just wondering if in your travels, are you getting any sense from the people you talk to about, are they changing, are they working through changing the way they sell the product, more remote sales, et cetera? What do you think may be the role of that in that resilience or potential bounce back?
Well, Ramsey, that's a good question. That is actually one of the silver linings that I'm seeing in this. And typically when I look at, the average insurance salesperson who's selling annuities in particular, they don't like change. And so let's just take the example of an insurance company changing that salesperson's favorite product. Based on the trends that I'm looking at, it generally takes more than a full quarter for that salesperson to become adjusted to those changes, feel real comfortable with them, and hit the ground running. What we've been facing because of the COVID outbreak is more an administrative change and how you do business. And I think that that's a lot more challenging than just a product change. Now, the reviews are very mixed from the people who are salespeople, though. So I have folks that were selling virtually, where they were very comfortable with Zoom and Skype and using tablets to communicate with their prospects rather than face-to-face meetings. And those people are saying, game on, business as usual. Right. I haven't faced any disruptions. And in fact, I think some of those people have even had increases in their sales. But for the folks that were working face-to-face only, they are really challenged. And although this started back in February, I'm still speaking with a lot of salespeople who say, I still don't have it down. I don't feel comfortable. I'm hesitating and my business is suffering. And I think that those are good opportunities to network with other salespeople and work closely with the marketing organization for tips and tricks, because the statistics show that if you are working virtually, you will actually have, I think the stat, and Paul, remind me if you remember that post, I think the stat is that you're able to meet with 40% more prospects by working virtually than doing face-to-face business.
I think, yeah. And Sheryl, I think the opportunity here is to say, how do I how do I not just survive? How do I change my business to do more? We've had a couple guests on here, Sheryl, who've said exactly that. They were working digitally, working remote before because they could do more. And, they're actually in a great position. We've been spending time with some of our, top agents and trying to figure out, well, how do we add value to them? So, Sheryl, we did a digital boot camp series. We turned an online course. It's actually been one of the most popular pieces we've had. Mark and I, Mark, was that just crazy the day we ended up just testing out, you can't make this one up, Sheryl, Facebook Rooms. I don't know if you've used it at all.
No.
We had one of our top agents pop in, and Mark, maybe just talk about, what do we hear?
Yeah, it was great. I mean, he was saying that his business is on the rise. He's doing a lot of virtual meetings. He's doing a lot of phone meetings. He said it really hasn't caused a big disruption in terms of, his overall activity. And, and really not even based on client demographics. So the older clients are going on Zoom meetings.
Wow.
They're comfortable, having a digital interface, which I thought was very, very positive to hear. I guess one question from your perspective is, do you see any variation based on distribution channel from the utilization of virtual meetings, whether it's the independent agent, wirehouse, broker-dealer, or bank channels?
I do think there is a difference. And I think that you really have to look at who are the clients that are participating in each of those channels and what is the average salesperson for those channels. So you look at, let's say, a bank rep versus an independent agent. Well, typically those bank reps are going to be a little bit younger than an insurance salesperson who's working through the independent agent distribution. And you have to keep in mind that the prospect or the client that a bank rep would be dealing with is used to getting that face-to-face interaction when they come through their bank and when they go in to make their deposits, where that's not necessarily a safety blanket for someone who's dealing with an independent agent. So I think there are a lot of variables, but definitely the embracement of technology and virtual selling has been a little bit easier for independent insurance agents than it has been for other channels. But I think that independent BDs are still doing fairly well. I would say that based on feedback I'm receiving, though, the banks are more challenged than other channels with this way of selling.
Yeah, I do think, though, it's the older demographics are getting on this stuff super quickly.
Yeah.
Sure, we've been experimenting. We're still, we did one sort of successful virtual client appreciation event for one of our agents in, down in the South. Mark's in Connecticut, I'm in New York. It's, you can't make this up. And we flipped the cameras on, and I don't know, he had probably 10 clients there. Mark, what do you think the average age of those clients must have been 78, right?
It was certainly the 70s, I would say, was the average age.
Yeah, and they were gathered around, and Sheryl, this is the funny part of this. And so, like, first of all, it's like not what I would have expected, and then not that I would have, inside our own company. I told people in a meeting, I said we should send some of these people in to teach our people how to turn their webcams on. What I think this would be a whole interesting study here over this pandemic is I think the churches are actually training this whole older generation how to use it because they got to go to church. It's all virtual. So I think it's going to open up some really interesting opportunities for advisors who are willing to experiment with this because they will be surprised that some of their older clients know Zoom better than they do.
Well, Paul, I think we need to give the seniors a little bit more credit because the introduction of the iPhone kind of changed their lives because suddenly they were able to see their grandchildren over their phones. And so I think that a lot of seniors embrace that technology quicker than even people my age. I'm used to traditional phone calling and, my grandmother was used to Facebook Messenger to call the kids face to face. So, and I wasn't even familiar with that capability. I didn't do that. I said, is that like a Zoom or a GoToWebinar, Grandma? She's like, I don't know what that is. I've never heard of that. So, I think that we need to give them a little bit more credit and realize that although they might not be using it in a business setting, that they may have experience with this technology. And I know, Ramsey, you've seen the stats on this. Seniors are actually the fastest growing segment of internet users in the country.
Sure. And it makes sense for precisely the reason you said. They want to see their grandkids. You know, transformation and innovation is always about pain points, and not seeing your grandkids is a pain point. And folks are very eager to make that change. And if they're already in Facebook and it's a matter of just clicking another button to see little Tommy or Jane, you know, they'll do it. And and the potential synergies with everything else that, you know, they do in life is meaningful.
So Sheryl, okay, Sheryl's advice number one is get the marketing departments out there working to get people virtual. What about from a product standpoint? You know, what should we be, you know, you think the same products, same solutions are going to, you know, be relevant for the next year and a half? What would you tell us to be working on?
Well, I'd say if all other things were the same and all that had changed is that we're now doing business virtually rather than face to face, I would be telling you to keep things simple, because it might be more of a challenge to describe more complex products using a phone or a tablet. Unfortunately, what has occurred is COVID really disrupted the industry through the volatility in the stock market and historical low interest rates by a 10-year treasury that is at, I think, like 0.58 the last time I looked at it. And I'll tell you that when the market collapsed in 08, 09, you know, we saw the treasury dipping below 2 for the first time. And it was like, oh my gosh, how are we going to price annuities that are, you know, fixed, declared rate, or indexed, because that 10-year treasury is our primary benchmark. So I think that really the products have been more affected by the market environment that is a result of the COVID outbreak, more than by the virtual selling versus face-to-face, really. And I think that people need to understand that when we go through periods of very challenging interest rates and just roadblocks in terms of pricing, that what you will actually see is increasing complexity in product development. And that's because, you know, if the treasury's up there and looking great, you know, we can even sell traditional fixed annuities, no problem. And you can't get much simpler than maybe a multi-year guaranteed rate annuity. But when the treasury's at levels like it is now, that means that sales are traditionally going to shift to indexed annuities, structured annuities, and depending on the stock market, the variable annuity product line as well. And what we're seeing is insurance companies trying to find a way to make those products more marketable. And Paul, I pulled stats this morning before this Zoom meeting just to kind of take a look at where are indexed annuity caps, for example. And my average indexed annuity cap is less than 3.5% right now. And so I think insurance companies are hearing insurance salespeople saying, I can't sell a 3.5% cap, help me out. And what they're doing is coming up with new and different ways to calculate the indexed interest, new indices outside the S&P 500, and even new ways to limit that indexed interest. And I'm not especially a fan, just because it complicates our story and maybe makes it a little bit tougher for consumers to understand. But I think everybody needs to know that this is cyclical. This happens every time we see a very challenging rate environment, and it will turn around at some point. But I think that people need to be prepared for more complexity, just because it's going to get tougher before it gets easier.
Yeah, so I'm smiling because designing those complex crediting methods was my old job. So I'm quite familiar with it. I've embraced simplicity in my current venture. So I just want to dig a little bit deeper on that. So I think you're absolutely right. Like, what ends up happening is when rates go down, when returns are lower, you see two things happen. People either go for things that are more complex, or in simpler products, they dial up the risk, like, you know, buying riskier bonds versus less risky bonds. But during this time period of adjustment, like, what do you think is the best thing for consumers and for agents to focus on? So the complexity is coming. We know it's coming. Should everybody just go ahead and embrace the complexity given the market environment, or should they stick to their guns and stay with simpler solutions?
Well, that's a good question, Ramsey. The first thing I'm going to say is that everyone needs to quit psyching themselves out, because when I speak with the insurance salespeople, they're like, Sheryl, I can't sell a 3.5% cap on an indexed annuity. You know, I remember when caps were at 9%. And I say, you know, stop for a second, knucklehead. Breathe and tell me, when was the last time you remember 9% caps? And they'll say, well, probably close to 20 years ago. And I say, well, do you think your client or your prospect has been shopping for index annuities for 20 years? No, they don't remember when caps were 9%. What they do know is that when they go through their bank drive-through right now, they're seeing certificates of deposit being advertised at 1% or maybe a little more than that. So that's the new reality. And we need to quit benchmarking to how competitive these products have been in the past and look at what are a client's other alternatives for safe money: fixed annuities, certificates of deposit, bonds. And I looked on savingsbonds.gov this morning, and they're not even offering their Series E bonds anymore because interest rates are so challenging. So we need to realize what the new reality and adjust to that, and take the consumer's perspective. But in terms of should we embrace complexity, you know, Ramsey, I think that depends on your client and yourself, because I deal with people who, you know, their demographic that they like to work with is maybe doctors, and others who say, well, I especially love working with engineers. I think that if you're dealing with somebody who is not as savvy financially, you probably need to keep it simple. And if you don't feel comfortable with that complexity, do not attempt to sell the complex products, because if you don't feel 100% confident in it, your client's going to sense that. You know what you're talking about when you go into that meeting. And so if that means this new indexing method on this product that you've loved so much is really hard for you to understand, maybe you're not discussing that indexing method, and maybe you need to look at a whole different product. But I really think it depends. And ultimately, what everyone needs to remember is that when it comes to indexed annuities, they're all going to return the same over a long period of time. It doesn't matter what index you're using, how you're calculating that indexed interest, or if the interest is limited through the use of a rate that's a cap, a participation rate, or a spread. They're all going to perform about 1% to 2% better than fixed annuities being issued on the same day. And for those who are buying into the unlimited potential for gain story right now, I'm just going to tell you that's a fable.
Yeah, well, just to pull on that's thread a little bit. You know, Sheryl, I've been in this long enough as you to see these swings between sleep at night. How does sleep at night insurance turn into, here are these obtuse indices where, you know, the period during a full moon gets excluded from your index, and the harvest moon gets doubled. In a very, and I'm going to say very unscientific study where it's Paul typing in indices just to see what the core, you know, proprietary indices look like. If you start to look over now, you know, we've had enough time period where you're not looking at these indices based on projections. You actually look at performance. Yes, these are not that much better or much more different than the S&P 500. You know, just to sort of take a counter argument, do you think this is the time now to just say, look, we've got these indices, but look at the S&P 500. Look at what's happening here and how we've been working and how our particular product works. I mean, is that a way to sort of take complex products and really kind of make them simpler to in the marketing process?
Well, you touched on the biggest trend that's driving annuity product development right now, Paul, and that is the use of what I coin as a hybrid index. Usually these are indexes that consist of one or more other indexes and often have a cash or bond component. Many of them are indexes that don't have a lot of history, and that really lends favorably to better pricing than S&P 500 options, and the ability to have better caps or participation rates or spreads. And really having the opportunity to market that unlimited potential for gain story is what's driving this. So when I started my business 16 years ago, we had 12 different indexes available from which to earn interest on indexed annuities. You want to take a guess how many we have today?
Mark, how many do you think?
I'm going to say close to 200.
I'm going to take the over on that.
Yeah, it's 116.
Wow.
Oh, wow. All right.
So Paul, to your question, do these perform the same as the S&P 500? I'm not an actuary, but I work with actuaries every day. And what all of the actuaries that I have worked with on these hybrid indexes have said is that it's not about the ability to outpace the S&P 500. It's more of the returns issue. So if you have an index annuity with the S&P 500 strategy, maybe the first year the client will earn 6%. Year 2, they earn 0. Year 3, they earn 0. On these new hybrid indexes, what you're going to get is probably in year 1, the client earns 2. In year 2, they earn 2. And in year 3, they earn 2. So it's more of a steady crediting of gains over a long period of time rather than the volatile ups and downs that you would traditionally see.
Got it.
And I'll just speak from somebody that, again, somebody that designed those. That we saw that as something that was very valuable for customer experience. We were able to bring in diversification through different asset classes and a sort of more consistent experience of return versus zeros and versus highs and lows. And I agree with you. I think the quality of those indices varies dramatically and the complexity varies dramatically. I will go on record and say I'm very proud of the work that I did. But I do think it is, from the consumer's perspective, it's difficult to understand, which of those indices are high quality and which ones are lower quality. So it can be challenging.
Ramsey, I actually have started reporting on indexed annuity and indexed life insurance sales at an index level about 10 years ago. And we're putting together a report right now that goes and does a deep dive into each one of those indexes that's been offered on these products and what makes up those indexes. What are the different constituents and what are the weightings for those constituents? And I think insurance salespeople would be surprised to learn that there are some of these indexes that charge asset management fees as high as 1.25% annually. And I think often the insurance salesperson, if they're selling a product that has one of those index asset management fees, might say, well, that doesn't affect my client because that's not a fee that's being paid on the annuity. And I think what I want to encourage salespeople to do is to research those indexes, because even though the index, isn't directly impacting the interest that's credited to the annuity, if it has an asset management fee of 1.25%, that is creating drag on the index. And therefore, the client's potential for index gains is going to be limited by that. And I just think that not enough of our salespeople know to do their homework and dig into those indexes, just because, I'm going to keep it real. The insurance companies want the agents to use them, and the marketing organizations do too. When somebody sells a product with an S&P 500 option, the insurance company has to go buy those options normally over the counter, and they pay a fee to an investment bank to purchase those options. And really what we're seeing is that a lot of the insurance companies offering these hybrid indexes are getting Sam's Club type pricing on these options in exchange for making these deals on these proprietary volatility controlled indexes. So there is an incentive for the insurance company to drive allocation to those hybrid indexes.
Yes, we could do an entire other show on that part of the business, and maybe we can someday, because that's something I'm particularly familiar with. So look, it's great perspective. I want to dig a little bit deeper on the structured annuities, because those are something that came into the fore in my last few years, and I thought they were very interesting. And maybe you can talk a little bit about some of the key elements that make them different. So one of them, of course, is there is some exposure to downside risk, which is something that's a little bit different than other traditional annuities.
Yeah, I'll be honest, I sometimes am wrong, Ramsey.
No.
Are you kidding?
Yeah, don't tell my husband. But structured annuities first came into the market, and I want to say it was about 2012, if I remember right, I kind of discredited them. And I said, who really needs a product that's kind of in the middle of the risk spectrum between indexed annuities and variable annuities? If they want higher potential for gains, the VA makes sense. And if they want downside protection, they're going to choose an indexed annuity. We don't need a middle ground. And really what I found not long after that, and speaking with salespeople and consumers alike, is that there was a demand for a middle ground. And so structured annuities are a securities product. And I think that's really important for some people to understand, because we've even had some regulators that are a little confused on how these products work. I even had, I want to say it was FINRA thought that structured annuities were indexed annuities, and they're not. They are a securities product, where an index annuity is a fixed insurance product. The client does have potential to lose money in a structured annuity if the market goes down, but those losses are limited, which is very different from a variable annuity, where you would be completely exposed to any losses. On the structured annuity, you may be limited by, let's say, no more than 10%. And then the trade-off is that you earn interest on the upside that is also subject to a limit, similar to an indexed annuity. And that's very different from a variable annuity. So where index annuities are currently capped at maybe 3.5%, the structured annuity might have a cap of 9%. So the best you can do is 9. The worst you can do is -10. And there is an appeal for that kind of product. I just really, when I look at that product and analyze it, it is very much where indexed annuities were at the same point in the product life cycle. And we've seen consistent increases in sales quarter over quarter on that product line. It is the fastest growing segment of the annuity market.
Yeah, so when those came out, and again, so having spent a lot of time working with insurance companies on variable annuities and a lot on FIAs, there was a period of time when I was trying to figure out, what would be the marketing appeal for this? Now we see it. There's a lot of popularity. I think that there clearly is a market for it. I'll be very interested to see how customers experience that product in a time of a down market. Because
right.
People experience losses in this sort of binary way. Like nobody pulls out the pom-pom and says, well, I only lost 15% instead of 35%. They might, but for the most part, they say it just feels like a loss. So I will be very curious to hear how people feel about it, because it's not an issue of pricing. So even if you priced it for 0 P&L for any of the intermediaries involved, you'd still have this issue of how does it feel to experience how does it feel to experience a loss for those products? So I watch with bated breath to see how people as it grows, how what the user experience is. I think there's a lot of interesting information there.
I think it's going to depend a lot too on how it's being positioned by the salesperson, because as we well know, variable annuities were the golden child of the annuity business for so long, because the salespeople were positioning it as a product where you could have unlimited potential for upside growth, but then you also had those guarantees that were provided through the living benefits. And we need to understand that right now, the structured annuity market only has 2 companies that have living benefits on their contracts. Mostly it's an accumulation play. And, the funny thing to me, and I don't know if Paul, you have heard this, or Mark, you might have, when I ask salespeople, why do you love this product? And, what did the illustrations look like? They say, oh, I don't use illustrations because this product is so easy. And that kind of jars me. And I say, well, what do you mean? And they say, well, the best the client can do is 9%. And the worst they can do is -10. So I don't need an illustration to show that. And it really, in my mind, sounds funny, because indexed annuity illustrations are almost like a safety blanket to our field force. And truly that story is the same, but it's a real stark difference in positioning and marketing. And it's really surprising to me.
And do you think a big driver behind that is because there's no riders associated with it? Like, I think riders, the income riders, are probably the big driver behind the illustrations in the first place with FIAs.
Yes, I absolutely agree, Mark.
It'd be interesting to see. It'll be interesting to see to Ramsey's point, the client experience. When they do experience, or if and when they do experience a negative term in those contracts. How aware or comfortable they are with that notion in terms of, yes, I can actually lose money. With the underlying thought of what index annuities used to be with that principal guarantee.
Yeah, I agree.
Yeah. Well,
go ahead, Paul.
Ramsey. No, please.
I was going to say, so look, this is fascinating. There's a lot of the environment is fascinating. The types of products that have become more popular is fascinating. Let's talk a little bit about what you see in the next couple of years, and in particular what you want the role of Sheryl Moore and your company in this market in the next, say, 5 years.
Well, I don't think anybody's ever asked me that question, Ramsey. That's a good one. So I do think it's going to be slow to turn around to get interest rates in an improved state, to get the market to settle down. So I do think annuity product development and annuity sales are going to be challenged for a while. But here's the another silver lining that I've been looking at, and that's the Secure Act. For those who are less familiar with it, that's basically legislation which is going to make it easier for employers to offer annuities within their employee retirement plans. And when the Secure Act first came out, I heard a lot of insurance agents that were really, really excited about this and thinking about their potential for sales. And I had to kind of temper those folks and say, whoa, whoa, whoa. Don't get really excited now, because this isn't something that's going to immediately contribute to your bottom line and your sales. There is a lot of administrative work that insurance companies are going to have to do before we can get off the ground running with that. And we essentially are going to have to build an entirely new distribution, because how are those insurance companies going to get in front of the employee benefits enrollment people to even get their attention to offer their annuity within a retirement plan? So there is some groundwork that has to be done, but here's the positive effect that I'm seeing right now. You're very familiar with the fact that I work as a fact checker for newspapers and magazines and journalists who are reporting on insurance products, including annuities. And it used to be 16 years ago, I would see as many as 8 negative, inaccurate articles about annuities a day. Thank goodness that is no longer the case, because I was very busy back then. But the positive effect I've seen from the Secure Act is that we're actually seeing positive press on annuities. And this is really the first time I've experienced that phenomenon, just because, most people don't even know what an annuity is. And when they do, quote unquote, report on annuities, they're often using primary data that isn't reliable or credible. And that translates to a negative bias against annuities in reporting. And I could do a whole other show on that, Ramsey, but I think the one thing I'm encouraged by is that people are starting to report on annuities in a positive light. And that means that more consumers are going to be saying, what is an annuity? And looking to their financial advisor and offering some guidance on whether or not these products might be right for them. Because the secret to us breaking open the annuity business and having access to those trillions of retirement dollars is really first educating people on annuities.
Yeah, I couldn't agree more. And I think it's one thing to have the legal protection that sort of removes sort of the ERISA-like, obligations of a carrier, but it's another one to actually work through an employer and the processes and the carrier to get to show up. But I think long-term, I think it's a game-changing impact, Sheryl, and I agree with you. I think the media impression is changing. They are starting to listen to voices like yours that speak articulately, intelligently, and give a balanced description of our product. So thank you for what you're doing.
So Sheryl, dare I make a prediction? So I asked you about where you'd be in the next 5 years, and I think your intuition on the Secure Act is spot on. It's going to take years for it to really get rolled out. And I just see a world where there are hundreds and hundreds, maybe thousands, but certainly hundreds and hundreds of corporations they're going to do a level of due diligence around what they do that's going to be way more detailed than I think what we're used to in the industry, and they're going to need data, and you have data. So I think if I look ahead 5 years, to me that just seems like an opportunity for which you are potentially pretty uniquely positioned. So we'll be watching.
Yeah.
Thank you very much. I'll still be here. I may
Hey, well, Sheryl, thanks so much for the time and showing up. As I said, there are sort of 2 milestones we're looking for. One is when that 70s show actually sends us a cease and desist letter, and we get you on the show. So
you
1
have
out of 2.
Thank you, Paul. I appreciate that.
Yeah, Mark, any thoughts or
No, I obviously it's great to have Sheryl on. I think she's spot on with the Secure Act and the positive change that we'll have in the industry going forward. I think also one component of that, with the requirement to show what an asset translates to guaranteed income, is going to be a big eye opener, because it's surprising how many people really don't realize what that asset is convertible to from an income standpoint. So I think her information is spot on, and I appreciate you joining us.
Thank you so much. I appreciate it.
Thank you, Sheryl.
Hey, thank you very much. And thanks to all of you for listening to this episode. And tell your friends, tell them to subscribe, tell them to listen. This is in particular a really good episode. And join us again next week for another episode of That Annuity Show.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.